before the investment. So we want to look at before the investment. So the interest cover before the investment, we said it is going to be the profit before interest and tax. But this is before, so we are going to take that as 3.6 divided by what is the interest expense before. So we look at the old income statement, which gave us 800. So once we divide that, we'll be getting 4.5 times. So we now look at after the investment. After the investment, then we need to know what was the interest cover. So the interest cover, we take the profit before interest and tax for that adjusted income statement, which was 4.680. We divide by the interest. The interest expense was 1.5. We take that the interest expense that was given to us, that we computed, and when you do that, it will give you 3.12 times. These are number of times. So you don't stop here, you need to comment. You make a comment. So comment, or what you call the recommendation or advice. What will you advise based on that? The advice. Now, based on the reduction, of course, based on what you have seen, the other one was 4.5 times, this one is 3.12 times. So based on the reduction in the interest cover from 4.5 times to 3.12 times, then you won't recommend. You should not recommend the investment, because we said that for the interest cover, it must be seen increasing all the time. However, since it is above, because now you may be locked in a situation whereby in reality, because we said that it should at least be above 3 times, because you can't say the business doesn't operate or doesn't continue, but we look at the scenario that since it is above 3% or 3 times, then we can advise the business maybe to look at what are some of these items that they can reduce so that they can be able to increase this number of times. So some of the recommendation would be they should at least reduce this so that they can be able to increase the interest cover, so that it can be a little bit better based on the information, because here it's not too bad since it is almost above, it's above 3 times. So that's what we have from that. So we need now to compute the financial gearing. Financial gearing, this is our part C. Parts of the question wanted us to look at financial gearing, and they gave us the formula. They told us we should use prior charge capital over the total capital employed. So we need to look at before then after. Before the investment, the financial gearing, of course, the prior charge capital here is 8,000 divided by, of course, here we are going to take the 8,000 plus the 24,000. That is going to give you 25%. Because this one multiplied by 100 to make it a percentage. Then we also look at after the investment. After the investment, the financial gearing equals to the 8,000. Of course, we have to add the 10,000. That was the new capital that was introduced. Divide by the 8,000 plus the 10,000 plus, of course, the retained earning, the other figure that we got of 2413. That is the figure that we computed from our adjusted balance sheet. It is 24,133. 24,133, and this will give you 42.7%. So what will be the advice or comment? Advice or comment? So based on the financial gearing, you won't recommend. We shouldn't recommend. Why? Because we are seeing it is a little bit increasing. It was 25%, but now it went to 42.7%, which has caused an increase. So since it is increasing, it means these people, they are actually geared, or they are becoming more geared. So we shouldn't recommend. But however, remember we said for financial gearing, at least it should be exceeding 100%. So since it is below the 100%, then we can say they should find a way of how they can, maybe they can decide not to pay dividends, so that they can be using that money for these other investments, so that they can lower this gearing, financial gearing. So since it is below, as the CFO, of course, as the CFO, you may not overcommit. Like, you may not overcommit yourself, but you need to be a little bit objective enough, because gearing will always remain in your capital structure. But the problem is when it is highly geared, because we said that it is only going to be highly geared if at all it has exceeded 100%. But if it is below 100%, of course you can't commit yourself that let's get more and maybe we'll be at 99% just because we are below. So you may not commit yourself to that, but since it is below, there is no way you are going to say, I'm not going to have debt in my capital structure, if at all you are struggling to raise your own capital. So what is very bad is to be a little bit geared, to be highly geared. So we said that since it is not above 100, there are two ways. You can say we are not recommending because we have seen an increase, because we expect the data at least to be lowering down. But you should also look at a point that since it is not above 100%, we can also say that since it is not above 100%, then the investment would continue, even though there has been an increase from 25%. Of course, you recognize that there has been an increase, but since it has not exceeded the 100%, you can say they should go on with the investment, but they should look at ways of how they can mitigate that in the future, because the worst case scenario is going to be when it has exceeded 100%. So that's basically what they wanted us to do. So I want someone to find ways, because we looked at some of these reasons. What could be the circumstances under which debt finance would be more appropriate? In other words, why would we take debt more debt than equity. Oh, because at some point, these are the points we looked at, the importance of debt over equity. Because these are the same that are giving us scenarios. Remember, the question approach is going to be a little bit different, but the answers are the same. So if at all we say that the interest on debt is tax deductible, it's a point, it's a circumstance that forces someone to actually prefer debt than equity, because we know that dividends are not supposed to be deducted. They're just an appropriation of the profit that we have made in the business. The things to do with the delusion of control, people are going to come in when you have equity. But here, there is no delusion of control. Management still has its own ways of how to manage the business. So I want us to look at the trial numbers. What are some of the trial numbers that we can have on this kind of arrangement? What are these trial numbers that we can basically look at? The reference numbers that we can go by, maybe looking at November 2019, question 5, part B. We can also look at August 2018, question 2. We can also look at November 2019, question 3. So you see these numbers are really examinable. So if you'll be able to do these numbers, you'll be able to actually understand some of these aspects. So without wasting more time, let's look at something else. We want to focus on things to do with the element. We try to analyze the elements of cost of capital. Elements of cost of capital. And that's what we are going to look at in the next video. So right now, I want you to be able to try out those numbers and also let us know in the comment section what you think of the video that we have done, or so far what you have understood or what you have not understood, any complaint, suggestion of any sort of something that you can add on what you have learned through this tutorial. So thank you for watching. Let's meet in the next video as we are looking at the elements of cost of capital.